Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
The second point, and this is the point where we think we really have a problem growing, it's on the trade tariff side of the fence. China's becoming more belligerent in a lot of different areas because they see their own growth starting to slow at the margin. The China PMI, Purchasing Managers Index numbers continue to grow, but they're not growing as fast as they were. China's running into an inflation problem. China has a massive real estate problem on their hands, and they're on one of those wheels. They continue to need more and more credit to just keep this game alive. And again, they're still using their export side of the fence to drive more and more growth, to be the primary driver of growth. And this is why they dig their heels in on the currency. If they were to revalue their currency, they believe they're going to lose a lot of jobs in the state-owned industries that are subsidized with state liquidity to drive exports. And that creates a social problem for them. So China is in a situation here where they can't clamp down too hard on inflation because they need to keep this game going on the export side of the fence and keep credit going. But if they don't clamp down on rising inflation and food prices in the country, it creates even greater and greater social tensions. Added to that, you have the U.S. politicians really running out of patience with China, given the fact that U.S. jobs have not rebounded. So we just see a huge amount of risk here with China in the U.S. obviously at the center, Germany at the periphery because of the problems it's creating for the Eurozone, but Germany in a little different situation. Germany not only is creating the problems for the Eurozone, Germany is also subsidizing the Eurozone to keep them afloat. It's a very, very tenuous situation. I'll get to that when we talk about the Euro in just a second. But you can see that these linkages that we see in the world and the risks we see in the world still come out of this global rebalancing. It's why this whole idea of the currency wars is being triggered. Currency wars, i.e., the money is moving so fast in the emerging markets of the world, it's starting to put more and more pressure on their currencies, as it should. When liquidity moves into a country in a big way, the currency should be there to be that buffer and go up in value. Of course, that does not happen in China because they suppress and they manipulate their currency. So it just creates a massive amount of liquidity inside the country. We call it kind of the Roach Motel of liquidity is what we refer to China. Money can go in, but it really can't come back out. And that's what's creating this pressure inside of China, this credit pressure. So, as I said, they have multiple problems on their hands. They have a lot of balls in the air. Rising social tension with inflation. They got to keep the credit going, but same token, they got to start reacting to the U.S. demand so that their currency go up. So this idea that China is going to grow as far as the eye can see with all these potential risk balls in the air, to us doesn't make a lot of sense. We just think it's inevitable China is going to slow down, and it's because exactly of this global rebalancing situation is the trigger, and they will slow, and when they do, it will change the dynamics in the currency market a great deal, and I'll talk to that in just a second when we talk about the Aussie. So hopefully that made some sense, and I know it's a little bit twisted and esoteric, but that to us is really the key driver still. So when you hear of global rebalancing, try and think of it in more terms than just U.S., China, and think through some of those linkages that create risk. We're bullish on the dollar index, and we said back in December of last year, November, that the U.S. dollar was setting up for a multi-year bull market. A lot of people thought we were pretty crazy for saying that, and maybe we were crazy for saying that, but we just, because of the global rebalancing in the background, because of the potential for a risk bid in the background, because of what's going on in the Eurozone in the background, looking at the dollar, it's a relative reflection of value. Keep in mind, currencies are always a relative game. So a currency can go up in price if the relative value looks good compared to its competitors. we as U.S. citizens look at the U.S. and see all the problems and all the warts, and there are a massive amount of problems in the U.S., more so than we've had in our lifetime from a financial standpoint. The irresponsible way in which we've used the world reserve currency status of the U.S. dollar is pretty ugly. So on a lot of different fronts, there are a lot of reasons to be very, very bearish on the U.S. and the dollar. But the reality is when you look around the world, a lot of places are really in worse shape than the U.S., which is hard to believe given how bad the U.S. is, which goes to our point that there's a major, major risk in the world still. If the U.S. is better off than some of these places, just by that, there's major risk in the world. We're finally starting to see the U.S. yield differential start to change a bit, and I'll show you a chart on that recently, which tracks very, very closely. It's something you can track yourself. We had thought, and we were wrong when we initially thought this, that we would start to see the U.S. start to grow a little faster than Europe, back over a year ago. We got a bounce in the U.S. dollar. Obviously, a big risk bid in the U.S. dollar, and it hasn't revisited those lows. But that was really the major driver of it. But we think going forward, this idea of U.S. negative yield differential against Europe is going to change. And we think, and I'll talk about that when I get to the euro. The Eurozone crisis, obviously, we've talked about the euro potentially being history for the last couple of years. The structure, anybody that really did a real analysis of the original structure of the euro, or anybody that followed Milton Friedman for many, many years as we did, understood or at least believed that the Eurozone structure was just a loser. And it's proving that way. So we just keep lurching from mini crisis to mini crisis, and we keep putting more, and the European Union continues to put more and more Band-Aids on this situation. But the reality is the countries that are in trouble just don't have the wherewithal to drive the wealth to get them out of trouble. And it's precisely because of the way the euro is structured. Germany is sucking the wealth out of the zone. Germany and some of the other countries that are more disciplined than the southern tier countries. Southern tier countries, precisely because they have to trade on the same currency, cannot devalue in order to make their goods or their services relatively more competitive against Germany and some of the other stronger producers, France and the Netherlands. So therefore, we have a whole tier, a whole section of the single currency that just cannot create the wealth. So their problems will continue to grow regardless of these Band-Aids. And the problem is the currency itself. They are locked into this straitjacket. And during the time from 2000 to 2007, in which the U.S. dollar was in a major bear market and credit was basically free, these structural problems were papered over in a very, very big way. But before the Eurozone or the euro came out as a single currency, all you have to do is go back before 1999 and look at the interest rates in Portugal and Italy and Spain and Ireland and compare them to what they were in Germany. They were, 200, 300, 400, 500, 600 basis points higher than Germany, as they should be, because there's a lot more risk in those countries. But voila, they create a single currency, and therefore all these interest rates are now at German interest rates or slightly above. It was a false, it was an artificial system, and we've had suppression of interest rates for the last 10 years. The market is finally starting to price the risk, as it should be, back into those weaker countries, and the interest rate spreads are blowing out.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.